Yeah, thank you, Mr. Chairman. A couple quick questions. First on privacy. How many of you read your privacy notices, cover to cover? You know, I was one of the advocates back in the 90s of the privacy notices. I think now we've had this great experiment. I'm pretty sure that if I got a privacy notice and I knew that I was receiving it only because there was an amendment to the privacy, I might actually look at it. Do you know, I guess this question for anyone, do you know if there's ever been a study on how many people actually read privacy notices? But yet we incur millions of dollars of expense every year promoting privacy that we have no idea whether it's actually a consumer protection or you know, in fact has the opposite result. People become immune to actually looking and preparing the response to their institutions. So I also want to just extend what Senator Moran was talking about in terms of examinations. One bad apple spoils the bunch. And I say that because these are institutions who feel under siege, either by regulation or by examination. When one thing happens within one institution, it has a chilling effect across the board on all the institutions, particularly in that state. And so, you know, where you may say, look, we maybe get 1% or 2% of complaints because of these issues, I will tell you that that 1 or 2% may have a much greater impact in the real world, because the chilling effect that you have when people feel like they're up against very high penalties, up against a lot of enforcement and enforcement obligations, their response is, let's just not do it, because I can't risk my institution and the penalties. And so I'll just say that Chairman Grunberg came to North Dakota at my request. Unlike Senator Moran's experience, our banker sat down with them and actually had a one-on-one, very, very candid conversation about concerns about examinations as well as over-regulation. I would tell you the follow-up there is, why does it take so long to fix this when there was a lot of head nodding, yes, I get what you're saying. And it's back to what we said last week, which is that we've got to act sooner rather than later, because we are losing the lending lines in these institutions. And in my state, 96% of all business is small business. This is the business lender of first resort. It's a rural lender, and we are seeing people retracting from that kind of lending because of concerns about regulation. Now, my main question is probably a little more esoteric, and it has to do with sub-S's, and I know that this is not something that in the broad scheme of things it always hits the radar here, but given the current housing situation in North Dakota, many of our community banks are having trouble getting timely appraisals. Many of the community banks in North Dakota are sub-S's. And I've heard concerns from many of them about the application of the Basel III capital conservation buffer. And you know that as C corporations, banks with capital deficiency under Basel III can pay their income tax before the dividend restrictions begin. Is the FDIC looking beyond the July guidance to allow S corporation banks to be granted the same flexibility? And this is a critical issue. I guess this goes to you, Mrs. Epperly.
Thank you. And Senator, we issued guidance in July discussing how we would use the exemption that's built into the Basel III capital rules about the conservation buffer. So the conservation buffer basically restricts the amount of money that an institution can pay in dividends if they fall below the full amount of the buffer, which is 2.5%. It doesn't go into effect until 2016. It's not fully in effect until 2019. Okay. Nonetheless, we heard concerns about subchapter S banks that they could fall below the threshold, and they had concerns that that would require their shareholders to pay taxes out of their own income on the income from the institution. So what we have done is clarify how we would use the exemption to the extent that we can clarify in kind of a blanket way up front. And so we have said that for well-rated subchapter S institutions that would be paying out no more than 40% of their net income to cover the tax obligation of their shareholders, that would remain adequately capitalized after doing so, we would generally expect that we would say yes. So there's a process for the institution to make a request, we would say yes. So we hear that institutions don't want to ask for things because they think we'll say no, so we've signaled ahead, we will say yes. We can't go below that, and that would be the same treatment that we would give to a Subchapter C corporation. We don't give blanket approval for an institution to be able to pay dividends or not be subject to dividend restrictions if its capital is under pressure, particularly when the capital pressure and diminution of capital could lead to the failure of the institution or the path to failure.
But these concerns just add to the weight of overall concerns, and I think are resulting in consolidation of our small community banks and reducing the vibrancy and reducing the numbers in a way that I think is not good for the American financial markets and for lenders and borrowers. And so it's really critically important that we understand not one size fits all, that all of this in a cumulative way has a pretty dramatic effect as we go forward. If I could just ask one more question, she's not paying attention. Anyway, given the current housing situation in North Dakota, many of our community bankers are having trouble getting timely appraisals, and they're frustrated. The appraisals come from out-of-state folks who really don't know the market, and I know I've frequently kind of told a story here. I come from a town of 90 people. We sell a house maybe once every 5 years. Good luck finding comparable sales in Matador, North Dakota. The FDIC has taken a look at allowing community banks to conduct, have you taken a look at allowing community banks to conduct valuations for smaller mortgage loans that they'll keep on the books? Will you commit to looking at that issue going forward? Because the appraisal issue in rural communities is real.
You know, the economic boom in your state has certainly contributed to a high demand for appraisers, and the supply is catching up. It's grown by 20% since 2012, since about mid-2012, the number of appraisers. So hopefully that's providing some relief on the supply side. The second thing I would say is that, you know, we do encourage institutions, and there has been confusion on institutions' part about when is an appraisal required versus an evaluation. We encourage institutions to use evaluations when they can. And we issued technical assistance videos this year on both appraisals and evaluations to clarify the difference between the two and when they are required. So yes, we do encourage institutions to use evaluations where that's appropriate.
If I can just make one last comment, and it's not intended to be a criticism, but you know, there's a lot of encouraging, and we've sent out this guidance, and I think if we had a greater level of trust between the regulators and the regulated, I think that all of those things would answer the question. But I think there is this sense that there's a gotcha world out there, and they're going to get me if I do something that really is coloring outside the lines. And I think we need to be mindful of building back that relationship. I think Senator Crapo made an excellent comment. We've started this process. We somehow can't seem to finish it, even though we've got great bipartisan support. We all see it. We got regulatory support, but yet it doesn't happen. And that's the frustration here from the community banks and really from Main Street America, you know, going forward. And so let's kind of renew a commitment to working together, renew a commitment to continuing the process that Senator Crapo initiated many years ago and actually achieve results, because all the talk that we have here is not going to amount to anything if we actually don't get results out of this process. So thank you all for the hard work.
Thank you, Senator Heitkamp.